Mark Reifer, and welcome to the Wise Wealth Market Commentary, where in 5 minutes I give you our latest market insights. November was eventful with the national election, the Trump trade, and plenty of corporate earnings reports. And as I record this on the last trading day of the month, the market, as measured by the S&P 500 index, is about to post another 5% gain for the month, making it the 10th positive month out of 11 this year. Yes, we've been spoiled. Last time I said the market is more occupied with the fact we're heading into the seasonally best 6 months of the year for stocks, namely November through April. And although elections typically add to market volatility, the odds still favor a good finish to the year. Will that continue to play out in November? So given the favorable investment climate, what could upend this bull market? I think there are two things. Number one, euphoria. Number two, the possibility of another financial crisis because of, you guessed it, the national debt and the unsustainable government spending. Last time we looked at euphoria, that's when stock and bond prices surge higher and investors fear missing out more than they fear losing money. Legendary investor John Templeton said it best about market cycles. He said, bull markets are born on pessimism, they grow on skepticism, they mature on optimism, and they die on euphoria. So are we close to euphoria? Well, I've seen more investors cross over from pessimism to optimism this year, but even though I can't time the market, I do think we likely have further to go, perhaps a few more years in this economic cycle. But in the meantime, the other big risk to this bull market is the possibility of another financial crisis, and that's our focus for today. So let's look at the problem, the perspective, and finally the prognosis. First, the problem. Of course, it's very familiar to all of us. It's that unsustainable government spending. And I want to give you 3 key bullet points to think about. One is the national debt in the United States is over $36 trillion and counting. The government now spends also $2 trillion more per year than we take in. Again, U.S. tax revenues are about $5 trillion, but the federal spending is about $7 trillion. Third bullet point. Interest costs on the national debt are now over $1 trillion per year and about 14% of the annual budget. That's larger than Medicare, and it's also larger than defense spending, the defense budget rather. So changes must happen in the next few years, or the global markets will push back by selling U.S. assets and in turn the U.S. dollar, only to buy them back at much lower prices. So what about some perspective, hopefully some positive perspective? Well, the U.S. is still doing better than the rest of the world. The United States is the dominant economy and the clear choice for the reserve currency in the world. You know, our gross domestic product, the goods and services produced in our economy, is over $29 trillion. Put that in perspective, China is next with approximately $18 trillion of GDP. But again, we can't really trust their numbers. They don't report numbers like the West does, so it's a little bit more of an elusive estimate. But all of Europe together, gross domestic product is about $15 trillion. Japan by itself is about $4 trillion, and if you look at the different pieces of most nations are well under $3 trillion. So again, the U.S. is the dominant economy, $29 trillion of gross domestic product. However, the U.S. must slow down its spending and get their debt to GDP, their debt over their gross domestic product, get that ratio. That's the one math problem I have for you today. They got to get that debt to GDP ratio back to 100% instead of the current 123%. Again, the national debt is $36 trillion. The gross domestic product is about $29 trillion. So the debt to GDP is about 123% of GDP. And that's really what the global investing marketplace is watching closely. So when you read the news, think about that debt to GDP ratio. Now, don't forget, the U.S. debt to GDP is still better than many nations. This is from the IMF website. Japan has a whopping 261% debt to GDP ratio. United Kingdom, 101%. France and Spain, 112% respectively. Italy, 144% of their debt to GDP. And of course, China is not reporting there, so we don't know. But that said, the rest of the world is doing a lot of the same thing, a lot of spending and overspending, but at least we have a much stronger economy. So the U.S. is like a successful business owner who's got the biggest and best business in town, where everyone needs to do business with him and is willing to lend him money. However, the lending will stop at some point if spending doesn't come under control. So what's the prognosis? Well, please hear me clearly. In my opinion, a financial crisis is not imminent, nor is it a foregone conclusion. The backdrop is indeed very concerning, but the situation can improve if the new administration and Congress use this time of economic expansion to pay down debts. Three things need to happen for a positive outcome. Number one is we need to see moderate to lower taxes. Thankfully, we don't have to raise taxes very much, at least not yet. In fact, a higher capital gains tax would hurt economic growth, and it wouldn't help the deficit very much, because even an increase from the 15% to a 20% capital gains tax bracket, for example, that only gets about $10 billion more of tax revenue according to the Congressional Budget Office, and that's not really making a big dent. So really, pro-growth policies are in favor. So far, the global marketplace does like the Trump victory and the prospect of his policies, which favored lower taxes and lower interest rates, by the way, to foster economic growth while simultaneously reducing debts through tariffs and a smaller government. We'll see. Second positive outcome, a thing we need for a positive outcome, is continued growth. Based on that size of our economy, the U.S. is one of few countries blessed to have a shot at growing our way out of it. We did it after the financial crisis. Before COVID, even with lower tax and capital gains rates, economic growth generated more tax revenues, and the annual deficit actually shrank several years in a row. Furthermore, the last time the U.S. ran a budget surplus was back in 2000, after the internet boom. Of course, President Clinton and also the Republican policymakers, who happened to have a majority at the time, they like to take credit for that. But really, it was economic innovation and the internet boom which generated enough tax revenues to run a surplus. Perhaps we have another such opportunity with the artificial intelligence boom, but this time it will also take a third important thing for positive outcome, and that would be necessary sacrifices. Well, necessary sacrifices, what I mean by that is economic growth may indeed reduce our annual deficit, but to reduce the national debt, we have to make sacrifices. And if we don't, the markets will push back hard, perhaps in just a few years. So don't be surprised if we see bigger changes over the next 5 years, including ideas like, number one, changing Social Security. Maybe the eligibility changes from the early 60s to closer to age 70. Perhaps means testing for Medicare benefits, or even seeing an increased payroll tax, maybe 1% on everyone, with also commensurate higher rates on the highest tax bracket individuals, maybe even as much as 49 or 50%. We've seen it before in U.S. history. Maybe we see it again. So in summary, the economic and market is currently in a bit of a sweet spot, the economy is in the market, with lower interest rates and taxes. And although the market is expensive, we don't think the odds favor a big sell-off because the investment climate remains favorable. However, we are looking for signs of euphoria in this economic cycle, and the global markets will continue to monitor the progress of the U.S. debt to GDP ratio. Well, thanks again for watching and for your patience, your confidence, and your trust. And we wish you and your loved ones a very Merry Christmas and Happy New Year. And we'll see you next time on Wise Wealth Market Commentary.